Now that we understand how loans affect the quantity of money supply in an economy, there are more concepts that we need to understand in order to start making the connections between money, interest rates, and exchange rates. We have seen in our fictitious economy how banking loans increase the quantity of money supply in the economy and how cash in vaults are nothing but reserves, which are a fraction of the bank's total assets. Now, like banks, there are other intermediaries such as savings and loans institutions, mutual funds, etc., and they all work in a similar fashion. As a research exercise, we can take a look at the loan-to-deposit ratio of banks in the US or any other country. Let's start making the connections. We know that interest rates and exchange rates are nothing but prices. Simply put, an interest rate is the price of a loan and the exchange rate is the price of one currency in terms of another currency, and both rates are determined by the forces of demand and supply, which we should look at soon. So we need to start making connections between interest rates, exchange rates, and these forces of demand and supply for funds. The sources of demand and supply of loans and currency, whether in the primary markets such as the credit market or the secondary bond markets, need to be identified. By understanding the various sources and uses of loans, of funds, such as households, firms, governments, and foreigners, and the forces that influence the demand and supply of these sources, can help us determine and anticipate interest rate fluctuations. Now, while studying economic indicators, we saw that the various economic entities that contribute to the GDP or gross domestic product of the country are households, firms, governments, and net exports. So these four economic entities are also key sources and users of the capital markets. The net export component, which we saw in economic indicators, is similar to foreign borrowing and lending. There is a large market in the US for the demand and supply of dollar loans and dollar-denominated assets. The demand by foreigners for US loans and assets, such as bonds, stocks, and commodities, are a function of interest rates and exchange rates. Foreign funds flow in and out of the country depending on their expectations of holding period yields. This holding period yield is a function of the interest rate plus exchange rate. This is because when foreigners lend in the US, they would need to buy dollars and sell their holding currency. Those looking to borrow would need to sell dollars and convert to their own currency. So when the foreign investor buys a US asset, they would need to sell their holding currency, the domestic currency, and buy the foreign currency, which is the US dollar. And when the foreign investor squares their position, they would need to sell the dollar and convert to their holding currency, which is their domestic currency. Now, this is also similar to borrowing and lending. Those looking to borrow would need to sell dollars and convert to their own currency. So these flows and conversions cause interest rates and exchange rates to fluctuate, which we shall look at in greater depth. So let's start by looking at the factors that affect borrowing and lending and investing by various economic entities. By understanding the effects of various factors on the flow of funds will help us anticipate interest rates and exchange rates better.